Okay, let's get going. Well, welcome to the first Great Partners uh, webinar here. It's pretty exciting stuff we have going on. I can't wait to share some of the projects that we're currently working on, and we have one currently while you're on right now that we're going to be closing, believe it or not, next week. So really exciting stuff. Takes a while to close these deals, and what can I say? In the next 5, 6, 7 days, we're going to have our 5th large shopping center closed, and that's what we're going to be talking about today. So let's get going. Everybody, my name is Alan Schnurr. I'm with Great Partners, and first we need to put up the disclaimer, right? I'm not an attorney. I'm not a CPA. I am a syndicator. I've been in the real estate business for the last 20 years. A lot of you know me, a lot of friends and family involved in our syndications. And there's some newbies on the line as well that are interested in the opportunities. So let's get going. And I'm going to explain why we do, what we do, how we do, and how long we've been doing it. And looking forward to talking about this deal that we're closing next week. Just more fine line disclaimers here. All right. So again, welcome everybody. My name's Alan Schnurr, Great Partners, and a little bit about me before we get going. I've been in the real estate business for the last 20 years. I've bought hundreds of houses, more than 400. I've bought thousands of apartment units, more than 2,000. I bought a couple dozen shopping centers, warehouse, and half a dozen ground-up construction deals with storage, ground-up construction in the apartment business, and some other crazy, wild, and wacky entrepreneur ideas like washaterias and lending business. So today we're here to talk about a shopping center that we're syndicating, but I first want to share a little bit more about me and who I am. I like to write books. I've written 3 books. You can see the cash flow mindset here in the center of the screen. And I've also spent a good 15, 20 years in the brokerage trading business. I've been in the commodity business, the stock business, and there's a picture of me in the trading floor on the right-hand side. And what's interesting about the way I worked my way out of corporate America was I always had this motto: get a bonus, buy a house. Get a bonus, buy a house. And I did for 1 month. For 10 years, every month I bought a house. And then I woke up one day and I had 120 houses. And lo and behold, that's how I got into the commercial real estate business. And to the left is one of my hobbies. I just got back from Russia, and I'm in the middle of climbing the 7 summits of the world. And for me, that's kind of number 3 with my, these are my real estate friends, but we have an adventure club, and perhaps as we get to know each other better, everybody's welcome to join us. We just climbed up Mount Elbrus, 18,000 feet in Russia, which is, I say Russia, but it's also considered the largest mountain in all of Europe. So a lot of fun, a lot of business. We actually did some transactions while we were doing this over a 3-week period. So let's get going. That's a lot about me, and I know a lot of people listening already know this. And one of the principal partners here at Great Partners is Adam Barker. Adam is finishing up summer vacation right now in Europe, where he's from England. He lives in Santa Barbara. And Adam's got quite the real estate portfolio as well. Like I said, I've bought hundreds of houses and thousands of apartment units. He's actually bought a little more than me, believe it or not. So he comes with a wealth of experience and knowledge too. And I'm sure the next time, our next syndication, Adam will be on. So where are we right now? Where am I with real estate? Like I said, houses, apartments, and now I find myself in commercial real estate in the triple net real estate business. And why is that? So let's talk about that quickly. When it comes to apartment buildings, when things break, or when taxes go up, or when insurance goes up, it's hard as the entrepreneur, as the owner, to keep up with those expenses. You'd like to think you can pass those expenses and costs on to your tenants, but they're laggards. So sometimes you can't keep up with them. And before you know it, your taxes have gone up 50% in 1 year, and you just can't raise your rents overnight 50%. So it's tough. And I found myself in that situation many times, and I finally found a new solution. And triple net real estate was the solution for me, because when you own these shopping centers and taxes go up, well, it's really not your problem. You are able and capable, and through the lease, you can pass those expenses on to the tenant. Taxes go up, insurance go up, you can pass those expenses on. Things break, and you can pass those expenses on as well. And we'll talk more about that. And when it comes to the syndication business, and really more importantly, predictable cash flows. You know, I could say this after 20 years of being in real estate. The most predictable cash flows come from this commercial real estate, and for me right now, retail shopping centers, because I can pass all these expenses on to the tenants, and I don't have to worry about not having enough money at the end of the month because something broke. Tenant has to cover it. I won't even probably hear about it. So we're going to talk about why are we so interested in commercial real estate and retail shopping centers. And I got to tell you right now, they're not the most popular asset class in commercial real estate. It's retail has taken quite the beating over the last 3 or 4 years, which really for you folks and me creates this huge opportunity, because the returns are risk reward. The returns are much higher right now in shopping centers than, say, apartment buildings. We're about to get into it, but when it comes to the apartment buildings, you're lucky if you can get a 3, 4, or 5 cap deal, which is like a 3%, 4%, 5% return. But when it comes to the shopping centers right now, I'm about to present a deal that has an 8.2, 8.3 cap, which means 8.2 or 8.3% cash on your money. So, and I'm going to share with you lots of reasons why I believe it's more beneficial and safer to go with, say, a Starbucks or a Subway or Quiznos or a bank or a chiropractor, doctor, you name it. I'd rather sign a 5 or 10 year lease with them than just a 6 to 12 month lease with someone living in my apartment building. So cyclical, counter-cyclical, immediate needs. We believe that retail centers, they should be located in the hearts of communities, geographically, in a situation, in a hard corner that's just irreplaceable. I mean, it's true. There's not enough land, and we look for those car counts. We want to be on those hard corners, and that's the kind of real estate that we like to buy. Let's see here. I know a lot of folks listening right now are involved in houses, involved in apartment buildings, and I want to bring this diversification play into your real estate portfolio with shopping centers. And hang on one second. I want to talk about the shopping centers, and I want to talk about how do we take our knowledge from what we know in the housing business and bring it forward into the retail business. And here's some of the guidelines we use when we're buying shopping centers. We look for deals that are a good 10 to 35% vacant, because when you buy these shopping centers, you're buying on true net operating income, true NOI. So let me give you an example. If you could buy a shopping center that was 50% vacant, and let's just say that the deal was $1 million. You paid $1 million for it. You paid a true NOI number, and it's 50% vacant, and you fill it up 100%. Well, you just doubled your net operating income, which means you just doubled the price of the asset. So when you buy a shopping center that's 10, 20, 30% vacant, what happens really is you get a discount on the shopping center. And that's what we look for. We're looking for a discount when we go in. So what do we look for? We don't really like funky, cut up, kind of crazy shaped shopping centers. We like inline shopping centers facing the road so people can see it while they drive by. We really look for high traffic counts, 30, 40, 50,000 cars a day. We like high density areas where people are kind of packed in, lots of apartment buildings. minimum 15,000 people within a 1 mile radius, up to 75,000 people in a 3 mile radius. Signalized lighting is really important for us because you could be on a highway and those cars can keep blowing by at 30, 40, 50 miles an hour. So you really need a traffic light to make sure that they stop. And the opportunity that I'm about to present here has traffic lights. So people are, if they don't stop on the first light in front of your shopping center, by the time they get to the second light, they're going to be stopped as well. We like to buy shopping centers where the medium income household is at least $38,000. It's kind of like the sweet spot. We like the Hispanic market. We feel like, it's the fastest growing demographic in the United States. And we have a lot of experience working in those markets as well. So a little bit more about great partners. Currently, we have over $100 million of commercial real estate that we personally oversee. We like to really target shopping centers, I'd say more or less 60,000 square feet or larger. Right now, we're about to have a conversation about a shopping center that has 100,000 square feet. We're not looking to reinvent the wheel. I'm not buying a broken apartment building anymore or carpet tile paint, fill it up, 2 years later, start sending out cash flow payments. The wonderful thing about the retail shopping center business that we're involved in, it starts cash flowing from day one. So really like a light value add. When we buy a shopping center, we'll go in there, we'll just clean it up. Maybe we'll power wash it. Maybe we'll change some of the fascia or do some quick paint jobs. But we're not looking to take on a major rehab job when it comes to buying shopping centers. So I'm really proud of the picture that I just came up right now. There's about to be a fifth slide there. So that's going to be our fifth large shopping center. And we will have around 600,000 square feet on these large shopping centers here in town in Houston, which is substantial, ladies and gentlemen. The first deal that we picked up around a year and a half ago was Wood Forest Shopping Center, 115,000 square feet. That center remains currently 90% plus occupied, doing very well, paying out quarterly payments as scheduled on the pro forma every quarter to our partners. And another shopping center that we own here in town, this one's 140,000 square feet. It's on a hard corner on a major highway here in Houston, has around 250,000 cars that go by it every day. Again, pays out like clockwork every quarter. You can see the names, the Discount Tire, the Food City, the Burger King, the Aaron's, the Subway, the Melrose, the Hart's Chicken, major names, just the type of business that we're in. We believe in diversification and diversification amongst our tenants. Look, I don't want any of my tenants to go away, but if Burger King went away on that pad site, it's not going to be the end of the world. They only make up probably only 5% of the whole entire shopping center. Even Discount Tire, they probably have around 15,000 square feet there. Again, you have 250,000 cars passing by Discount Tire. I don't think they're going away, but if they did, it's okay. The rest of the center will carry us. So another shopping center that we recently just bought was Fairmont Junction Plaza here in Pasadena. And that's a really exciting shopping center that we just bought because there's a major supermarket coming in. They took 45,000 square feet. And that's really one of the reasons why we bought this shopping center. It's a Latino shopping center. Again, we believe in the Latino markets. And again, this one comes with the hard corner. If you can see that green patch of grass right up front, well, it's going to be a matter of time where we put a QSR up in the corner there, which is basically a quick service restaurant. So maybe a McDonald's, maybe a Burger King, maybe a Hart's Chicken, maybe a Starbucks, who knows, maybe a Verizon, maybe an AT&T. We're working on that, but that brings immediate value to the shopping center. Another center we have is in College Station. This one's above 100,000 square feet. And what you don't see, but you do see that red van in the parking lot up front by the road, is a Krispy Kreme's donut went up there, and we did a land lease there, a 20-year land lease, increased the valuation by $1.3 million when we signed that 20-year land lease with Krispy Kreme. Not only that, we increased the valuation of this particular shopping center by $3 million by immediately filling the vacancy with a restaurant, a Gumby's Pizza, a Once Upon a Time Child, it's like a clothing store, and a salon. So some of our tenants, take a look. I mean, I call this multiple streams of income. Burger King, TJ Maxx, Krispy Kreme Donuts, Didi's, CC's Pizza, BPL Plasma, Solar Salons. This is the business we're in. I'm no longer in the business of collecting rent checks from the apartment buildings or the houses, but these are 5-10-year commercial leases. They're guaranteed. It's almost, some of these companies are AAA credit. So it's another reason why we believe in retail and we continue to grow our portfolio. Currently, we have around 125 of these companies, Fortune 500 companies in our portfolio. So the deal that I want to talk about tonight right now is Fairmont Plaza. It's in Pasadena. I know Pasadena very well. I own a lot of property there. I've flipped a few hundred houses there, a half a dozen apartment buildings, and I have lots of commercial real estate there as well. So let me tell you a little bit about Fairmont Plaza. It's 102,000 square feet, and it also comes with a hard corner where we're going to develop a pad site. And what's really attractive about this deal that I like is that it comes with some major anchors. You can see right now the anchor tenant stability. It's a Planet Fitness. It's a new 10-year lease. It's actually a brand new Planet Fitness as well. They've spent a lot of money building it out. They spent a year putting it all together. It looks great. I was just there the other day. I worked out. I like it. And next door to Planet Fitness is a store called Dirt Cheap. If you know them, there's 100 of them in the United States. It's kind of like a Marshall's TJ Maxx motif, good financial condition. I looked them up on the New York Stock Exchange. We also have Dollar Tree. And so as you can see what it says right there, 57% of this center is made up of national names. And that's how we like to do it. So, I mean, Dollar Tree sends a check, Dirt Cheap sends a check, Planet Fitness sends a check. And I can tell you more about the center. There's a wonderful Mexican restaurant where I go there once a week and I have lunch. There's Ichiban, is a Japanese restaurant, really good hibachi over there. So, and I'm going to show you some more pictures of the center in a second. Value add opportunity for this particular center on Fairmont. The shopping center currently it's at 92% occupancy. All right, so immediately we have upside of filling up the vacancy, but more importantly, it cash flows from day one. So when we close on this deal next week, 90 days later, or we try to stay on the quarterly calendar, fiscal quarterly calendar, you get a check, you get a cash flow check. And I know a lot of you are interested in, well, how much can you make? Let me finish explaining more about this project, and then we'll go into the numbers. All right. So easily accessible. It's on Fairmont Parkway. Again, it's like 1 mile away from Beltway 8. 225 is around the corner as well. So it's really well located, and you know what? It's just irreplaceable. Let me show you some more pictures. There's a picture of the shopping center. You can see all the trees. You can see all the houses. You just can't build stuff like that anymore, and you can't build it at that price. Let's see. There's a map of where the shopping center is located. And let me just talk about the demographics, because demographics to us, when it comes to buying shopping centers, it's really important. You want to buy a shopping center where there's a daytime population and there's a population that lives there as well. So, and you also want to make sure that the population is increasing, right? So as you can see, the 1 mile radius is almost, it's above 14,000 people. And more importantly, check out the 5 mile radius. Within 5 miles of that, one shopping center has 300,000 people. That's off the charts. We really like it. So another reason why we moved forward with this particular project. We like household incomes. You can see they're looking pretty strong, 54,000 on the 1 mile radius and up to 77,000 on the 5 mile radius, which is really important. Again, you can see the site, you can see what's surrounding it, you can see all the home parks around it, the apartment buildings, the major highways and roads. So this is, we call it a pictogram. We use this when we're working with leasing agents to really describe the shopping center. So you can get a better view here. You can see all the way to the left, one of the major anchors, I believe it's around 24,000 square feet, dirt cheap, 100 of them in the United States. Then you got Planet Fitness. There's 1,500 Planet Fitnesses in the United States. Solar Salon sticks out as well. I'm really interested in actually the brand itself. There's 400 of them in the United States, and it's one of those places where you go in and people rent their own spots where they'll cut your hair, they'll give you a massage, they'll do your wax or whatever. So it's a great business model. It's really disrupted the salon industry here in the United States. Dollar Tree, great name, and I told you about Ichiban, the Japanese restaurant. It also has a Quest Diagnostics, which is, I believe they have 45,000 employees throughout the United States. They're just about on every single continent, and I believe they are the world's #1 provider of laboratory services for healthcare. So there's a liquor store there, there's a doctor there, there's a personal trainer there. You can see. Just some more maps here of the area. So we can dive into the numbers here. Basically, currently, the property itself has around $972,000 of rent coming in. And again, here's what I really like about triple net business is that the insurance, you can see it costs $73,000 a year. The property taxes cost $279,000 a year. And well, let's just talk about those two variables right there. Those numbers change all the time. They're not so controllable, especially in the housing business. Makes it hard to make a profit when you think you're having a great year until you get your tax bill. That is not the case here. A budget's created, everyone agrees upon the budget, and all the taxes, all the insurance money is escrowed throughout the year. And what happens at the end of Q4 or the beginning of Q1, Jan, Feb, March, we reconcile the difference. If we're under, well, then the tenants send us a check. And if we're over what we collected, then we have to return money to them. But it really helps control the cash flow for the business, why I love commercial real estate. So as you can see, I mean, the base rent's $972,000. And you can see the effective gross income here is almost $1.5 million. And I notice how it actually says total expense reimbursements. I mean, that's beautiful. I mean, there's $516,000 more or less in expenses that is being paid for by the tenants. So that's why your revenues are almost 1.5, but your rents are a little under $1 million. So what's our business plan here for this shopping center? Well, we're already buying it around 92% occupied, right? So we're really buying it for the cash flow stream, and we're buying it north of an 8 cap or an 8% return, which is fantastic, right? It really is fantastic because we're getting the money at 3.7%, or let's just say a little under 4%. So you're borrowing the money at 4% and you're getting an 8% return just on that. I mean, there's a lot of upside here, and we're gonna go into that. So we're looking at a good 5 to 7 year hold. This particular loan, we got interest only for 10 years. And we really love that because, you know, we don't have to worry about paying down the loan. And all we have to do is execute on our pro forma, improve the property, build out the out parcel, and keep the cash flow open, as I would say, wider, because less principal is being paid down because it's interest only. So we plan to lease up the vacancy. We also have other methods of increasing the revenues. Rent bumps are built into these leases between 1 to 3% each year. So on a 5-year lease, you're looking at 10 to 15% increase just on the lease alone. Now, some people might not renew. Some people might not be invited to renew, or some people's rent was maybe too cheap. So we have all these opportunities to get in there, improve the property, and increase revenues. So depending on market conditions too, I mean, we might find ourselves refinancing, returning capital, or maybe not, and we just turn around and sell the property when the time comes. So on this profit and loss statement, just want to talk about what it really looks like. Let's start with year 2, because year 1 we're already buying it in the middle of the year, so there's only a few months left. But as you can see, as I reach for my glasses, you're looking at cash flow from operations to be $433,000 just from really the difference between what we're paying the bank and what we're collecting. So there's a huge opportunity here, and I want to bring your attention down to the left-hand corner of the screen, because we can just start with returns at an 8 cap, all right, based off of our hold here for 5 years. Based off of an 8 cap, which is pretty much what we're buying it for. So what we're saying is, if we don't really change the cap rate, if we don't really do too much to the property, and we can sell it for what we bought it for, take a look. For somebody that invests $100,000, we would expect $181,000 return 5 years later. Let's keep going on. If you invested $250,000, we would expect $452,000 return, and for $500,000, a little under $1 million return. Now, if you start compressing the cap rate, see what happens at 7 point, just 0.2 of a point, the numbers start going up, right, on your return. So there's a large financial package, and I would suggest, if you don't have it, dive into it. But here we are in the webinar, and I don't want to lose everybody. But what we really aim to do is we try to double people's money, or get close to it. It's either a 3, 5, 7, 10-year pro forma, but we've taken a lot of time, a lot of effort to look at the leases, because as the leases burn off, you need to figure out, well, can you re-sign the tenant? Do you want to re-sign the tenant? Because you got to make it attractive for the next buyer. So anchor, let's say Planet Fitness, 10 years, okay? That's a long runway right there, 10 years. So basically what we're trying to do is, maybe if we held the property for 7 years and there was only 3 years left, well, if we can get another 10 years out of them, well, that makes the property more valuable, it compresses the cap rate, and it makes more money for you, the investor. So, people ask me about the exit strategy all the time when it comes to these shopping centers. And, I say, well, look, there's a few different strategies that I've done in the past. We can refinance, and everybody can get their investment back, and you can let it ride with not much money in it. Or if we decide to keep the property and we refinance, well, then you cash out at market rate. So that's another exit strategy. Another exit strategy that we've done in the past is we've sold the deal and we've all 1031 into another deal, or we just take our profit and go. But for this particular deal, this is a cash flow play, and I see us holding on to this for a good 4 to 7 years, because we're already buying it at 92%. Again, we're not trying to reinvent the wheel here. It cash flows from day one. So if you're looking for an investment, it starts paying 8%. And the way it really works for us before we buy the deal is it has to pay out 2% cash on cash to our investors. So if you put $100,000 in the deal, it'd be $8,000 in cash flow payments throughout the year, $2,000 every quarter. And I'm really proud to say that on the last 3 that have gone through our cycle, has paid exactly what we said we were going to pay. And we send out right now around probably close to $500,000 every quarter in cash flow payments. it's real, it's happening. This is how we make a living. And a lot of our partners have bought more than one syndication with us because they see it working. And there's really another valuable component to this as well. And a lot of it has to do with the political environment that we find ourselves in, which is depreciation. Let's talk about depreciation real quick. Basically, you can take commercial real estate and you can depreciate it, straight line depreciation over 29.5 years. If you want to do the lazy way, you can write 3% off a year. What does that mean? If you spent $1 million, you could write off $30,000 in losses a year. Well, just to get right to it, President Trump basically came across and said, you know what, write everything down in 1 year. So what we find ourselves doing is taking 50 to 65% of the asset of the purchase price and writing down this depreciation loss. So for example, let's just say this deal we're talking about right now is $11 million, which it's 11 million and change. So we're going to do a cost seg report on this deal, and we're going to write it down 60% year one. So 60% of 11 million, let's just say that's $6 million and change, right? So think about it for a second. The raise itself is like $4.2 million. And we're getting a $6 million loss right off the bat. So what I've seen over the last 2 years is when you receive your annual K1 from us, it comes with a depreciation loss. And the average person's been getting, on every $100,000, I've been seeing anywhere between $60,000, $70,000, $80,000 loss, depending on the deal. I mean, that's huge. If you can take the real estate loss of say $80,000 against a gain of $80,000 against a W-2 income tax bill of $80,000, you can take that real estate loss and you can now wipe out your tax liability. Look, I am not a CPA. I'm just letting you know what I'm seeing out here, and I'd be more than happy to talk about this offline, but it's a huge benefit because it's like you're making 30, 40% on your investment the first year on top of your 8% free flow cash flow payments. Okay, so back to the deal. You see the Planet Fitness is there, Dirt Cheap is there, Dollar Tree is there. They got 15,000 stores in the United States. We talked about Solaris Salons, they're there, 400 stores, Quest Diagnostics. This is how I like to do it. Really good names, painting with a twist. So let's see here. Next steps, review and complete investment packet. So if you're interested in this deal and you don't have the investment packet, well, please reach out to me, Andrew, or Adam. I know you know how to get in touch with us. My phone number, 713-503-5908. And also, you can hit me up. I see. There it is. There's our contact information. Really important. Write it down. Give us a call whenever you want, and let's talk about it. If you're here in Houston, we can definitely go out and grab a cup of coffee. But if you're interested in retail shopping centers, we're very good at it. We are really good at it, and we'd love to get you on board here. And let me just see what's left here before I say goodbye to you. Well, look, so this deal is actually closing on Wednesday, and I believe Wednesday is September 4th. But there's some space left. It's a $4.2 million raise. We're totally almost there. We're making this webinar a little late because all of us have been traveling in Europe and around the world, and we're also trying out some new technology. But you're totally welcomed, and we're going to go out until September 6th. So if you're interested, you have to sign up by September 6th. So minimum investment is $50,000. We accept IRA funds. Been doing that for years. And I'm about to open it up for some Q&A and see what perhaps questions you have, what I haven't covered, or what you want to talk about. So Andrew here is going to open up the line. Unmute. Okay.
If anybody has any questions right now?
Hey, does anybody have any questions? Want to talk about anything? Was that a no?
Does anybody say anything?
Hi, Alan. It's Lan.
Hey, Len.
Hey, what's the length of the lease remaining on your Planet Fitness?
10 years.
10 years on those guys? Okay.
If I'm off on it, they haven't even been there for a year, so it was a fresh 10-year lease. But they just started paying rent like 6 months ago. The build out took almost a year. It was an old Randall's.
Oh, wow. Okay. So who are they the largest?
So I'm not looking at that pictogram, but I believe, if I know my numbers, the Planet Fitness is 25,000 square feet. The Dirt Cheap is 24,000 square feet.
Okay.
So those two right over there make up like half the center, and they're fresh new leases.
That's great. Thanks.
Yeah, for sure. And yeah, I guess yeah, we'll keep it all. Lan's a good friend of mine. He's in another deal in Pasadena, and Lan, I actually just got off the phone today with the Rancheros supermarkets, and they're working feverishly to be opened by Thanksgiving for the Thanksgiving rush. So,
Great to know.
yeah, for sure. So great. Are there any other questions out there? Okay, well, I'll tell you what, we're gonna call it a wrap. And